Good evening, everyone. Welcome to tonight's live stream. We got a great program for you tonight. Hopefully, you can hear me okay. And if you can let me know where you're coming from in the chat. So, if you can let me know where you're coming from. And tonight, we're going to talk about all things financing. And we might even throw a little bit of NIFA on there. And I got a great guest for tonight's show. If you don't know, my name is David Matney with Nebraska Realty out here in Omaha, Nebraska. And you're watching the Living in Omaha YouTube channel. But tonight, for my guest, I have Erik Soderholm with Fairway Mortgage. So without further ado, I'm going to bring Erik on board. Hey, Erik, how you doing?
Good. How you doing? Thanks for having me on here again, David.
Awesome. Well, thanks again for coming back. I mean, I tell you what, 2026 is off to a pretty rocking start. Would you agree?
We are here.
Yeah. All right, and we have James is in the house. All right, James. Well, thanks for stopping in. All right, terrific. And so hopefully everybody can hear us okay. But Erik, how was your Christmas? Everything go okay Christmas wise?
Everything was great. We, I was a little bit sad that we didn't actually have snow on Christmas. That's kind of weird to say. I did buy myself. Well, I got a. I've never bought a snow blower. I didn't want to store it. I've always shoveled, and this year I bought some snow shovel attachment that goes on this Ego weed eater device. I'm pretty excited to use it.
Yeah, that'd be fun.
Snow for it yet, so but it's all good though.
All right. Well, that kind of guarantees us that we won't get snow now. But today was beautiful. Today was 50 degrees out. January in Nebraska, you just simply don't know what you're going to get. And hey, we got Clark is in the house. All right, Clark, well, welcome on board tonight. All right, and then we have MH08. What's a live stream without MH08 on there? So it's great to see you guys. And then, all right, and then Clark says, "Welcome back, Erik." All right, and then. MH08 says was 80 here on Christmas Eve. Wow. And you're in Denver, is that correct? I believe it's in Denver. So that seems unbelievable.
I remember, I think the last real time I remember going out and going to I think we went to the country club here, Champions, and really got after it. It was many years ago. I was much younger. But it was one of these years where the weather, it was so cold. I think I remember them saying it had the same temperature as Antarctica. I'm not joking. I remember it was the year when everybody would throw water in the air and it'd turn into snow powder.
Oh, yeah.
Absolutely miserable. So go figure. I'm older. It's nice weather and we don't really go do anything.
Yeah, I mean, there is Mount Crescent. I mean, over there, but I don't know how they survive with the weather. You know what I mean? I just don't see how that. And MH08 is in Denver. Unfortunately, I can't believe it got up to 80 on Christmas Eve. That's just crazy. Yeah, well, Erik, I'll tell you what. Let's kick things off in terms of the financing. Take us through kind of, everybody talks about getting, pre-approved and things like that before you go out there looking at homes. Kind of take us through the pre-approval process. What does the application process look like? What does a buyer need to do? And what are some of the paperwork that's required? Take us kind of through that if you don't mind.
Yeah, I can run through. I mean, I don't want to go too in depth. I know we've got plenty of things to cover in here, but there's different levels, or I guess depends on, there's a pre-qualification, there's a pre-approval side of things before you really get into a full-blown application. If it was my opinion, I think the best way to go about it, especially into 2026, for what I think is coming down the road, is to go through and get a full-blown pre-approval where, before you even go out and start looking at houses, right? Or really seriously starting to inquire online as well, because it's an emotional thing. Real estate is. You very well might catch a house you like, and if you're not already in a position where you've had a consultation and know what you're trying to do, you're probably already too late for that particular house. Maybe not in January right now. Houses are sitting a little bit still. Pre-approval, you can take an application over a phone call with your lender. You can do an online application, or you can, go old school and come in and sit down in person and take it together in person as well. Usually they're gonna need your personally identifying information: name, date of birth, social security number. You have to give authorization to pull credit.
Okay.
Whether you want a hard pull or a soft pull done is, depending on your timeline when you think you might be making an offer on a house or really being serious about shopping.
Mm-hmm.
We're going to need to gather income and asset documentation. So a pre-qualification, they can fill out the information online and kind of input. My income is this, my assets are this, I work here, I do this. And a lot of lenders will pull credit and they can figure out some way of what you inputted into the system or told me. And I run it through an automated underwriting system based on what we talk about. And if it tells me, yes, you can do it, it's more of a pre-qualification with really no due diligence involved, right? A pre-approval is going to go a bit further, and we're going to ask you to actually supply us pay stubs, W-2s, bank statements, tax returns, asset statements, bank accounts, get a little bit more detail about what type of loan program that we can approve you for. Are you looking for a 30-year, a 20-year, 15-year? How much down payment are we going to do? And we actually have a little bit more of a consultation, and the lender, myself or my processor, the team here, can do some due diligence in making sure that not only what you put on the application or told me matches up with the documents that we've taken a look at, so that what we're putting into the computer and updating before we run it through any kind of automated underwriting system is, the computer's only going to give us the answer that we tell it the information for.
Okay.
So if we're giving it bad info or not accurate information, it might give us a yes that says you can do it. But when we actually gather the documentation later on and it's not what we said it was, then that can change things down the road. So pre-approval is very valuable and gives not only your lender, but the realtor and yourself a lot of confidence in that you're not going to have, bigger issues that could have been easily resolved up front, taken care of up front. So.
Gotcha. And they can do that right online, just like on your website here. They can apply right online, and then you can upload the documents right online as well.
Secure website. It's very simple to do. Anybody can do it from their cell phone. We have an app if you want to download the app, so you don't have to get onto the actual internet. But cell phone, tablet, computer takes 15 minutes to fill out, and then it gives e-consent when you do that, when you fill it out online, which is nice because that does help us and help them as we go forward, speed the process up and be able to send things out electronically. But then if they have digital or can download copies of bank statements or pay stubs or any of the items that are required, they can drag and drop or browse and upload in there, label them what they are, and it comes over securely directly into their application here rather than needing to email documents and things like that. But I leave that up to the borrower. Some of them say I'm only going to email you securely through my channel, or I'm only going to bring by my hard copies in person, and that's fine too. I'll get a chance to meet them and make copies here and hand them back to whatever's easiest for the client.
Okay. All right. Hey, it looks like we have old Fred Sacco's in the house. All right. He hosts a show on Monday nights called Corn Nation. It's a Husker. It's and Angie is in the house. Angie Madcat is hello, Angie. Welcome. Thanks for stopping by. Erik, what do you see in terms of how if somebody's gonna how soon should they have that conversation with a lender if they're thinking about buying a home this spring? How soon should they reach out?
Now.
Exactly. Okay.
The earlier you can get in and get your application, and it's gonna alleviate a lot of potential stress down the road. It can also help yourself or your lender that you're working with plan better. We can review credit if you're not looking to buy till spring. When we pull a credit report, generally speaking, it's valid for technically 120 days. We can do a soft pull if it's worrisome about where things are now, but at least enough where, if we can review what's out there, there's a large number of people that have inaccuracies or, data on their credit report or stuff that they don't think was there.
Right.
We can try to help clean up, or maybe you need to, maybe it would benefit them to pay down some balances or could do a consolidation of some of the other bills. Anything we can do to make sure that they're help get them in the most, get them in the best position we can at the right time for them when they are trying to shop. So
gotcha.
Credit isn't something that generally you can just snap your fingers and you get your credit fixed the next day, even though Credit Karma told you your score went up. Right? It takes a little bit longer for 30 or 45 days in some cases. And we want to make sure that we talk about, if you do this, how much of your assets are we using to do that with? How much is that going to benefit you? And then how long would it take you to replace those assets that if you were planning on using them to cover down payment or cost, or making sure you're not eating into all of your reserves or anything else you might have for, actually when you're in the home, making sure you still have a cushion behind you and stuff. So planning isn't a bad thing, right?
Exactly.
And if you're going to talk to some other lenders, it'll give you some time to, interview and sit down and, not only terms, but who do I think I want to work with? Or are we going to communicate well? A lot of that's very important in the home buying process, right? Getting confidence with whoever you're working with, whether it be your agent or your lender, because it ends up being a team in a lot of cases. So
it is. What do you see right now in terms of things that are tripping people up in, during the application process? What do you see are some of the biggest stumbling blocks right now, or how many stumbling blocks are there?
Well, it depends on which part of it we're talking about, because as a loan officer, I hate to say it, I've been doing this for almost 20 years now. And from the beginning until now, for some reason, it seems like it's still very challenging to just get documentation from the borrowers.
Yeah. And it's got to be complete documentation.
Right.
Whether it's a bank statement, it has to be all 4 pages, even if that 4th page, page 404
they've become, ever since probably since the COVID hit, right? Prior to COVID, prior to 2020, and even back before that, it was a little bit more lenient. Hey, it was it's credit good. It was more credit driven, right? If your credit's really good, they're a little bit lax on a couple other areas, assets and reserves. It wasn't rubber stamped by any means, but it was but it was just looked over. Now they're a lot more document heavy, doing a lot of due diligence. So just making sure that we have everything and in the right format, so that it's going to be accepted by people. A lot of times we get into a purchase contract, and whether we do or don't need to move very quickly and close from start to finish, I can only make my team go as fast as they need to, and we'll put as much attention to it as we can. But if you're not supplying us with the documents we're requesting in a timely fashion, I think a big misconception from whether it's first time home buyers or not is, hey, if my closing date's January 15th, as long as I get you the stuff by the 12th, we'll be fine. Because we're not closing to the 15th.
Right.
Unless there's the right expectations set up front, which is key. And especially if we're able to get, we're not talking the day before you're going to go make this offer on the house, where we have time to really educate the borrower how the process works, so that there is a, expected, or a mutual agreement on how things are going to work in order to hit your timelines. So just getting documentation turned in seems like it's still, always a pain in the butt sometimes. But when it does happen and you have a borrower, or a client that you say, I need this, and it comes through stacking order, pristine, next day or the day after that, it's like, okay, this is going to be really fun and easy to work with. So, that's but I think debt to income ratio is probably the sticky point. What people are struggling with in terms of qualifying, and not necessarily qualifying, but qualifying maybe for what they want in a price point, right? When you factor in higher taxes, higher homeowners insurance, still elevated interest rates, a lot of people will go out. It's common, you get online, get the interest peaked, maybe go out to go see a house or two, really to kind of narrow down through all of this easy, searching on your phone, what I think I want, the price range I want, and then getting to the lender, talking, and then realizing, oh, my payment's going to be a lot more than what I thought it was going to be for that house. And then it's hard to backtrack from there into a lesser of a home that maybe, I don't even call it a lesser home, just a different home than what you had already set your mind on to. So then we're squeezing tight to try to get them up to where they wanted to be, so that it's a little bit of give and take, and how many borrowers and opinions are brought into that situation. So I find people stretching their budget whether it's now or just to squeeze them in underneath approval guidelines. And so I think income and debt to income ratio is probably the sticky point right now.
Gotcha. Okay. And Clark says, I agree. Talk to a lender up front to see how to create a roadmap for your housing journey. Exactly. Clark is a realtor down in Atlanta, Georgia. So if anybody needs assistance down in Atlanta,
Nice.
and he's one of my moderators, so it's always good to have Clark in the house. And then Angie has a question here. Angie says, question for Erik. Do you know what the minimum percentage of a mortgage loan you need to still use a home as a write-off?
Do you know what the minimum percentage of a mortgage loan you need to still use a home as? I think she's asking, like, I don't know. She asking how much of the house you need to be to use to consider like a write-off.
I'm not sure. That might be a tax question for
I
a
was going to
tax
say when
advisor.
it comes to that, even if I properly understood, I would tell you it's best to ask your
Tax advisor on that one. Yeah. I mean, the last person you want to take tax advice from is a real estate.
Considering it's tax time, right? For New Year, everybody's getting ready to do the taxes.
Or they're filing extensions.
And they very well might have probably just changed something again on the tax code. You never know. Seems like
exactly. Before we came online tonight, you mentioned something that really was interesting. That I thought you mentioned something that in terms of new guidelines for conventional repairs.
Oh, and I don't even know if I would say that they're new. They've just either maybe they're the same and they've decided to put a little bit more emphasis on it, or I think the guidelines have been adjusted. I just talked to an underwriter yesterday. I just had an appraisal come back on a conventional purchase, and we got flagged for a repair. Right. And it's not, in my opinion, again, what I'm used to and I haven't seen in a long time. I got to look at the picture of it. There was a window that had maybe a rotted board on the bottom, right?
Yeah, which is very common.
I mean, I don't think, and it didn't seem like it was outlandish. The window wasn't cracked. They had pictures of the inside and it's on the garage, on the attached garage.
Okay.
There wasn't any water damage on the inside, but the appraiser flagged it to be repaired prior to closing due to potential future structural damage.
Gotcha.
And we replied back to the appraisal management company and said, hey, this is a conventional loan, not FHA or VA or government loan or anything else, right?
Right.
They basically replied back with, yes, we know, but it's the same, they didn't give us any break. So I had to call underwriting. Sure. And my underwriter said, yeah, you know what? We've been seeing this a lot more lately. They've tightened up this, the conventional guidelines even. So they're just, collateral is being, a little bit more looked at, a little closer with the magnifying glass, I guess, at the moment. And I have mixed feelings on that myself. One, right. We want that as an avenue to go conventional because there are a lot of situations that I can just rattle off where a seller doesn't want or have the money or the time or the ability to do repairs.
Right.
And there's other, concessions of some kind that come up to be able to keep that deal flowing nicely. There's also situations where, the last few years we've had these ups and downs, buyer's market, seller's market, where I felt so bad with clients that are needed to go FHA or VA. And it felt like for a while, they were really getting hit over the head saying, no, you're going to have to go conventional.
Oh yeah.
In order to compete because the sellers didn't have to do repairs. So I also say, well, if conventional starts flagging some of these things, maybe it'll lean off a little bit of it's hot and heavy conventional only type of thing.
Yeah. Okay. Angie has a clarification here. She says, another lender told me that you have to have specific loan amount to use your home as a write-off. We're planning on paying for a house in full, but we're thinking it would be more advantageous to owe a certain percentage.
Definitely a good question still for a tax advisor. But if you were going to pay a house off in full, I would imagine, again, don't take this as financial advice, but I would imagine that your home's paid off. You no longer have any interest that you're paying on a loan. And there might be a portion for your income, tax bracket, however you do it, or interest that you may have been getting some tax benefits from. If it's a primary residence or an investment property, that can make some difference there as well. Taxes should be fine. Yeah, it's a good question. Unfortunately,
that's a good question. Yeah, well, I need to have
you for being in a position where you even have that as an option.
Yeah,
I've never been in that.
That doesn't happen too often. You know what I mean? Now let's talk about. I think an advantage right now for buyers is that are seeing um, buyers are seeing concessions from that seller to where the seller is paying closing costs now. Are
With
you seeing more of that?
where we're getting seller credits?
Yeah, seller. The seller paying the buyer's asking the seller to pay a portion of their closing costs.
Yeah, and up until, God, like I said, probably 3 years ago or so, when the market really flipped on its head, maybe it was more than that. For a large portion of my career, it felt like most of the transactions, should you want one, was able to get a seller credit involved into here.
Yes.
60-70% of them, I think, was at least eligible. The sellers didn't really have a bat an eye at it.
No.
It was explained, and it was usually worked out one way or the other. And then again, once it got into this full-blown multiple offer situation, over asking price, doing anything you could to stand out to try to win in a sea full of offers coming at them.
Right.
Then we weren't getting that. And the last, it's the fourth quarter. I guess I don't want to call it the fourth quarter now, or probably the first quarter, but in the cold season, historically, every single year, the market lightens up. There's not as many buyers out shopping in the cold, and prices in general are lower than what they are in the hot season. I think OABR had it on average was between $30,000 and $33,000 less in the cold season versus the winter versus the summer historically.
Right.
But that also then means that you've got room for negotiation, seller credits, and, whether it's to pay closing costs or help with buy downs or even repairs or inspections. I've had almost all of the deals I have now have something that I wasn't able to get on the deals about a year ago.
Right. And I'm seeing more of that too, where it's like, hey, they're getting a little bit of the ability to negotiate and a little bit of closing costs in there. So I think that's an opportunity for a buyer. And we have another comment here. It says, a home is not written off. You can either depreciate it if it's a rental property, or you can use it for a mortgage interest reduction or an interest paid up to the first $750,000 of the mortgage amount. Okay, I see what you're saying. As far as for an investment property, maybe she's looking at like having a office at home, a home office where you can depreciate that. Maybe again, that now rental property, I know you can depreciate, depreciate the 27, is it 27 and a half years depreciation on that. So yeah, I see what he was talking about there. Okay. Maybe that's what it is. Okay. And it's, he says, it isn't a percentage. Okay, gotcha. Okay, again, that's all tax advisor stuff. I mean, and here's the thing. I think it pays to have a tax advisor. I've had a tax advisor for many years, and I'm telling you what, they save a lot more money than what they cost. I mean, it is, if you don't have a tax advisor, then you're your own tax advisor, and you're probably giving yourself terrible advice. Do you agree with that?
Yes and no. It depends. 1040. If you have businesses, if you have multiple properties, or I just know I've been. I'd rather have somebody else confirm and help
exactly
make sure that I've got help if something does come up, rather than me trying to follow something. But anymore nowadays, there's probably very good reason to say that AI or Tax Pro or whatever's online is probably perfectly fine for a majority of people. But I would also agree. I'd rather pay somebody professional for that set of things.
I mean, being self-employed and then having for many years, I had rental property, so it was always a giant headache. So I never.
I will tell you this much: most of the people that know that stuff or have, I mean, when you're in a position where you really need one of those people, they seem to know their stuff inside and out really well. So
yeah, I mean,
I know that I'm missing out on options because I don't have any rental properties. It's one area of this I didn't get into, and I can't believe it.
Yeah, no, it's a different world now than it was 30 years ago. I mean, I was doing it for a long time, and I'll be honest with you, I don't miss it. It was fun at the time, but when it ceased,
a lot of people now are or have been over the last couple of years. Anybody that had not anybody, but a lot of people that had their homes that they bought or refinanced when the rates were down in the 2s and 3s and historically low, and rent prices had gone up so quick that many of them found out that, hey, I can rent out my primary house I'm in for a a good amount more than what
Right.
I owe. And I don't want to go buy an investment property. I'll just turn this into one, and then I'll go buy a new one. And,
Exactly.
that's one of the probably many factors factoring into not having enough homes on the market.
And that I would agree with that, in terms of, there's, let's see. And Angie says, I'll definitely ask our accountant, just thought maybe knew. Yeah, no, I
Wish I
appreciate
did,
that.
Angie. I
Yeah, no, that's all right. What would you say are some of the biggest mistakes that you see buyers do that they don't at the time? Because I always tell buyers, it's like, hey, before you do anything with your accounts or move money around or anything like that, talk to the lender. The lender, you got to be teamed up with a lender. And what do you see some of the things that buyers do that it's like, oh no, why on earth did you do that?
It depends on what phase of the process they're in. If it's somebody that already got into a contract, then essentially it's just communication, right?
Yep.
Trying to make sure that if you need to do something or think that you're going to do something, it sounds so weird because I'm not in a position to tell somebody, no, you can't do that, right? But if we talk about how this could impact your loan process or your loan approval or the timeline, then if they still decide to do it, it's they didn't just make a mistake, they knowingly made a mistake. But
Right.
quitting a job, changing jobs, changing industries, going from a salary to a commission, even if it's more money, buying a car.
Yeah.
And again, those things happen sometimes. I had a client that got into a car crash, totaled his car while we were in the process of buying a house.
Right. Wow.
That thankfully he was okay, and
Right.
we just closed on it not that long ago, and they were in good enough. He had to go get a new car, but we just made sure that we explained it up front as far as the credit inquiries go, and we made sure that the payment that he was going to have was the same or less than what he currently had. And so again, they ended up being all okay, but he communicated it immediately, right? Which is great, and I felt bad for him, but it was great to be able to know and then be able to preemptively tell my underwriter and my processor, we just had this happen. This is what we're going to do, what to expect, so that it didn't just hit the table late in the game. And then when we do our final, I don't even say a credit check, but when they do, basically making sure that no new liabilities had popped up, 10 days usually before closing, that there wasn't a surprise on us at the end. Gotcha. They still would have been fine, but it would have definitely created a headache for me and from the closer to the underwriter to my processor back down to me. I would have been the black sheep and not telling anybody, begging for help and smashing something through when it didn't have to be.
Okay. MH08 says, best way to find a lender in another market. Great question.
I don't know. A lender in another market.
Well, I can tell you what I tell my clients that are relocating to Omaha. I say, they reach out to me, and then I say, hey, reach out to Erik.
Yeah, I was going to say, I mean, if that's in that market, right?
You know what I mean? I mean, if you know an agent in that market, an agent's going to be tied in with a great lender in that market. You know what I mean? So I would.
I would say a lot of times you'll find out that if you go to a Facebook, if you go somewhere, somebody that's spending their time or their money or doing something like this where they're marketing themselves and good reviews, whether it's Zillow or Google, somewhere along the lines, you at least want a starting point, and then you can get connected. Or if you've got family or friends or coworkers, to ask around who they used, who's the local lender, who's a good bank. I mean, using somebody local is, in my opinion, very important, especially if it's across state lines or anything else, because each state's different, has different taxes and closing process and everything else. So,
well, and I've had a couple clients that we used a few years ago. I had one client who insisted upon using their out-of-state lender, and lo and behold, that thing blew up on us.
Well, here's a good idea too: is if you're not a first-time home buyer, if you've already used a lender, right, wherever you're at, if you're moving, but you've already gone through a process, bought a house or did a loan of some kind, depending on which kind of institution you went through, you can go ask that lender that you know and trust and have a relationship with.
There you go.
You have somebody out in this market that you would refer me to, or let them kind of help connect to somebody out there. They might know professionally, hey, here's a good place. I know this company also does the stuff here, that type of thing. So we have fairways in, I think, all 50 states. So it's not to say that I know this person at this place directly, but I at least know the company and how the process and everything works. So I can call out, get a hold of the manager and try to get somebody connected there. So.
Oh, now talk a little bit about underwriting, because everybody hears about the underwriter and underwriting. Kind of explain what that whole process is and who the underwriter is, because it makes it sound like some mysterious person in the bottom of the bank or whatever. But can you kind of enlighten us a little bit on who the underwriter is and what they do and what their role is in the process?
Yeah, I mean, as far as it depends on again, there's so many different pieces of this here, but getting through, I use analogies a lot. So I tell everybody getting a loan done is a lot like putting a puzzle together as a team.
Okay.
At the start, the client, borrowers have all the puzzle pieces.
Yeah.
Pay stub, W-2 tax returns, bank statements, credibility, credit, they lay it all on the table, and you work together with your loan officer up front to figure out what type of picture we're trying to make, at least build out the outside edges, and then we move it to the next stage where the processor or front loan officer assistant or somebody is going to put some more of those pieces together based on the picture we're telling we're going to try to make.
Okay.
The idea is up front, working with your loan officer, what type of loan are we doing, how much of a down payment are we doing, and knowing why we're doing these things, right?
Okay.
So that way we know what documentation we need to be able to provide to say that we can do it. So as it moves, the underwriter, by the time they get the file, right, it should be put together pretty well for them to review everything that we've told the computer system, right?
Okay. And
got a Fannie Mae, Freddie Mac, FHA, VA. We run it through a computer-generated underwriting system that says, yes, this works. Then we're essentially turning into the underwriter all of the documentation for them to go through and do their nitpicking and verify that, yep, the income calculation's correct, this is correct, the credit, title, they're reviewing the appraisal, the collateral, they're reviewing everything that's put together to make that picture what it's supposed to be.
Okay.
They're not usually you're not going to catch an underwriter that says, I disagree with this fundamental rule of this loan program we're doing that you didn't do something. They're just trying to say, prove to me with better documentation or an explanation or this, that they meet the criteria for this loan. So they're kind of as the final boss that you have to be able to convince that they're going to let it pass through to the finish line, right?
Gotcha.
So when they first look at it, they'll give you, whether it's an approval, usually conditionally approved, with it's approved, but you didn't do it perfect. We still need these three pieces, missing a pay stub, homeowners insurance. Tell me about the homeowners association dues, or I need the appraisal back. Gotcha. Before we can give you a clear to close. But it looks like everything else is right outside of these couple of pieces we need, right?
Okay.
As far as or you can get a suspense, right? Where if we didn't get enough documentation up front or the wrong documentation and we turn it in and the underwriter looks at it and says, I can't even give you a yes or a no on this. Take it back. It's suspended right now until you can properly document and give me the stuff I need to give you a decision. Right?
Gotcha. Okay.
Or just a denial. Hey, you're not meeting guidelines. This is not correct at all. There's no restructuring or you really need to restructure this if we're going to have any shot. And if you have a great relationship with the underwriter, sometimes they'll sit there and go, okay, you did this as this type of loan and I see why. I can't get it done that way because of X, Y, or Z, but you should think about maybe restructuring it to something like this. Right. Because it looks like it would fit this. And then you come back to the loan officer and talk to the buyers. Hey, our plan didn't work. We need to restructure it and try to change around what we're doing if we want to move forward. This is what that would look like, how it would change your terms of the loan. Is that something you're comfortable with? We still need to talk to the other people involved and make sure they're comfortable with it. So but that might be sometimes you just chose a conventional loan and you were doing a Fannie Mae loan and they have their guidelines, but maybe instead you should have gone Freddie Mac, which is almost, it's still a conventional loan, but maybe, I don't know, maybe they haven't been at the self-employed for as long and Freddie Mac will allow 1 year versus Fannie won't. So just working with somebody up front again, that's, I don't want to say experienced enough, but has done enough due diligence that the plan that you put in place to start with is going to stay the same, right? Nobody likes surprises and have to change things around. So that's why getting in early and often and making sure that's all put together before you go out is going to give everybody a better experience. And we all know what to expect without any surprises.
Now, how long will a pre-approval letter be good for?
Well,
typically, or
typically 60 days from
okay.
when it's a real pre-approval, because that's how long income and asset documents are typically valid for before they're technically expired. It doesn't mean that it's no longer going to work or that you have to start over. It just means that if it's outside of that time frame, we're going to need updated income and asset documents, because your pay stub from September no longer, meets the timeline of when we need to be able to verify that. So
gotcha. Okay.
Or, there could be numerous different items, but credit, again, is typically valid for 120 days on a hard pull. And even if it's outside of that, there's several clients that weren't able to find a house, or did find one but couldn't win. They had to make several offers, or one disappeared before they can go see it because they were both at work or something else like that. And then usually, emotions go up and go down. They take a little bit of a break and get back on. In order to really be back in that position, you might have to get a new credit report pulled, or you might get into contract on day 52, right? Or and for some odd reason, the seller doesn't need to close for a little ways out, and the closing date's going to be beyond your credit report expiration.
Okay.
If that happens, which isn't completely uncommon, you started with somebody, got them pre-approved, started looking, finally found something, and the closing date's going to be out past that credit report expiration. You want to make sure, I shouldn't say you want to make sure, the lender should be making sure and advising as well that we have these dates figured out. If your closing date's going to be beyond that, we need to strategically make sure that we're getting credit updated at the proper time so that it's valid and not having some last minute mistakes. I've had problems in the past where, this gets overlooked. We're human, right?
Right.
Or even if it's a day late from the credit, you can't just extend the credit one day.
Right.
And if we waited too long to get credit repulled so that there's active credit when you close, if credit changes, drops, well, it doesn't mean it still doesn't work for the loan, but that can affect your interest rate, and it can flip around a lot of different items. So there's just a lot of little nuances that you have to pay attention to make sure that everything's going to match up with your closing.
Okay. Chels 904 says, do you recommend shopping for lenders? If so, what questions would you ask them? Great question.
Yeah, for sure. 100%. As far as shopping for lenders, if you're starting with the lender first with no, suggestion from a realtor or a referral from a friend of yours that closed the loan, or maybe you're just doing Google reviews or anything else, right? I would always suggest having a phone call to start with and asking them what their process is like. What are my options? What loan programs do you have available?
Right.
How long does it take? Are there any costs up front that you charge to do a consultation? And before it, or a pre-approval, right? Are you willing to meet in person? Are you here locally?
Right.
Do you have, and then I would also tell you that if you're going to, this is just me being selfish, if you're going to shop for lenders, there are some certain reasons why you're going to want to be in a position to, I shouldn't say you should definitely want to shop for lenders, but you usually have about 15 to 45 days, depending on the credit provider, to be able to have credit pulled for a mortgage. It understands you're shopping for a mortgage within that time frame. So it's going to, instead of like buying a car, you go get a car loan and they pull you at the dealership and they pull your credit 10 times from 10 different lenders.
Right.
That can really take a big impact on your score there initially, because it shows all these different credit inquiries.
Right.
So if you start up front off of maybe a recommendation, or you work through somebody to see how you feel, and then if you're going to really get into shopping, you're going to want to do it in a certain time frame so that you can narrow down, who do I mesh with? Why do I? What are their terms like? Get an actual loan estimate rather than, if you don't get a loan estimate off your application, then the numbers on there really aren't valid. It's
right.
But you're going to want to compare the APR. I can maybe I can find a little cheat sheet thing to send out here at one point in time. But the reason I say that is because you want to take the upfront time before you're shopping for a house to nail down who's the lender I'm going to work with. So if you want to interview 3 or 4 of them, do it in a 2-week time frame so you can decide, I like this person, I'm going to work with them because of X, Y, and Z that were really important to me.
Right.
You should be doing the same thing essentially with your realtor, right?
Yep.
How many transactions have you done? Are you full-time, part-time? What what do you like to work with? Basically fill them out, because
Right.
I think just as important as the lender or the realtor, one way or the other, is your communication habits and just how you get along with somebody. You have to be able to trust them to represent your best interest. So
Right. No, I completely agree. But that's a great question, and I can tell you this: the time not to shop for a lender is once you're under contract. You do your shopping before. Would you agree with that?
100%.
Yeah. Once you're under contract, part of that contract is the lender, and you guys are under it's a heavily regulated industry, and there's certain things that have to be done at certain timelines and notifications and certain disclosures that have to go out so many days before closing. There's a lot of things that you guys got to do on your end, but I can tell you this: the time to not shop for a lender is once you're under contract. You do all your shopping beforehand. That's why it's good to start early in the process. Would you agree with that?
I would. If for some odd reason you thought you had it right, and it's, again, you might decide you're going to work with somebody for one of many different reasons. Primarily, maybe you would choose one person because their interest rate is lower than what the other person was, right? And but then once you get under contract, you can't get a hold of the person. They're non-responsive. You get the actual loan estimate from the initial disclosures that come out, and it looks different than what you were told. So at that point, you might want to get some advice from your realtor. If you're going to do something, you're going to want to change it early and often. Very early in the process rather than waiting later on. So you might be able to get your realtor or somebody else in the process with you to put a little bit of heat on that lender if they're not responding. So there are certain circumstances there. For a while, I was getting more calls to save deals than I had in a long time, where there were so fewer transactions, I think, on average for most people the last couple of years, that both real estate wise and lender wise, where I've just heard horror stories of people, telling somebody yes, they can do it, and then try to throw it against the wall to see if it sticks because they need to get a deal done or something else for the matter. And then too late in the game, it falls apart, and then parties are calling around to find somebody to save a deal, right?
Yeah.
And there was a time frame there where I think I was getting 2 or 3 of those calls a month, and that was I love to be able to do that for people when the answer is yes, we can do it, and I can probably still hit your closing date. We're gonna, you already got most of your stuff together. But a lot of times those are also people that have somewhat more of not a cookie cutter loan situation.
Right.
And it takes, a lot of time and effort and due diligence and
a lot of work on
anybody in the process, where everybody wants the answer yes right away. And I've learned I don't do very well at home with this, but I can't always be the yes guy. Right? So I don't like to tell people something that I can't do. If it takes me longer to get you those answers in that point in time, it's for a reason, but I communicate that, right?
Gotcha.
Self-employed, we've got this going on, you have that going on. Maybe I can get a hold of the lender and have them tell me directly what they ran into. Sometimes it seems like you're not getting a straight answer from people. So
right. Well, look at this. This is like teed up perfectly. Look at this. Look at this question. Chels 904. Do you work with NIFA? I'm still learning. So
yes.
Let's talk a little bit about NIFA, because I think that is a great opportunity for folks and for people to understand that. So take us through what NIFA is, and you're NIFA qualified and have been doing it for a while, and you've helped a lot of my NIFA folks go through that.
Looking for a form here. I love NIFA. I love NIFA loans. I think they're great for first-time home buyers, second-time buyers. It can be a really useful option to be able to at least cover with people, depending on certain circumstances. So they have different programs. So NIFA is not a type of loan, right? It stands for Nebraska Investment Finance Authority. It's a state agency offering some phenomenal first-time homebuyer options, loan programs. Oh, thank you for pulling that up. I guess I'm over here using my mouse, like you can see it on the screen. Conventional loan, or a government loan. So they have VA, they have FHA, USDA, Fannie or Freddie. And essentially what you're looking at here is, and you have little links you can click on here too, but NIFA.org is the website.
Yep.
If you're willing to do a little bit of reading and poking around on here, they really do a good job on their website of giving out a lot of information, including if you're really wanting to just prep yourself, because it'll be something you need to take down the road anyway. If you're going to do one of those programs, they have a first-time homebuyer class you can take online.
Yeah.
It's meant for low to moderately low income households. At least the first home program is first-time home buyers that meet certain criteria. But everything else about the loan is pretty much the same, right? You're going to have conventional, what the down payment requirements, the closing costs are usually a little bit discounted depending on which lender you're talking to. I know the processing fee, they cap certain costs. They do have income limits, which is what the thing I was pulling out here that I have on my desk at all times. Depending on how many people are going to live in the household, your file technically gets looked at. I don't want to say underwritten twice, but I call it underwritten twice. We try to make sure that you're making enough money to afford the home and to meet the guidelines for Fannie Mae or Freddie Mac or FHA and VA. And NIFA double checks to make sure that you meet their income requirements for the certain type of loan program you're going to do. Most people, I look at NIFA a lot of times if they're inside of these parameters, because, for instance, the first home conventional loan there, today's rate, I think, is that from today right now?
Yeah.
Yeah, it was at 5.75%.
That's amazing.
That's better than I can do. I can't take a perfect credit score person and do a conventional loan at 5.75 today. I just don't have the ability to get that low. It's a state subsidized program. That's a great rate. And the difference is too with conventional, they have a minimum credit score, right? You need to have a 640 credit score or better. Be considered a first-time home buyer, who is somebody who hasn't owned or had ownership interest in the property in the last 3 years. But last time we did this, we talked about NIFA. If anybody's on there from there, they called me and gave me props. They also told me, hey, you don't have to be a first-time home buyer. You forgot, if you're in a targeted area, you don't have to be a first-time home buyer. So they have certain the targeted area even has lower rates. There's a lot to look into here, but USDA, everything else. So they have a situation where you can go, let me get that off my screen. You can take either a great low rate and still do the same down payment, same closing costs, same tax and insurance, just like normal.
Yeah.
But you have to meet some certain criteria to have and stay underneath income limits and purchase price limits.
Right.
Then you get a great rate, and depending on where your income lands, you can even get discounted or cheaper private mortgage insurance than typical. Right? Okay,
excellent.
Now you can do FHA the same way. Otherwise, a lot of times we'll find out that first-time home buyers are short on assets, right? They don't have. Maybe they even have enough, but they were going to wipe out most of what they've saved up when you take into account down payment, closing costs, tax, and insurance. They give you an option to compare that I would always compare, called the home buyer assistance, where the interest rate on the first mortgage goes up 0.25%.
Right.
And they let you borrow additional money onto a second loan that you pay back over 10 years at 1% interest, and that can cover down payment or closing cost or taxes and insurance. You can combine it with the same seller credits you could have got before.
Right.
And in many situations, you buy a home, and I've done plenty of them here, where you buy a house with no money out of your pocket at closing.
I've had some where, it's fun to see, because it'll be like they will have that way they can keep that money. They're getting into the home with their financing, but they have money in reserve just because life is going to happen. Right.
Yeah. And I've been through different areas of my life. I'm a big believer in reserves, extra reserves.
Oh yeah.
I think we've all experienced the ups and downs with pricing and on everything, let alone job losses and anything else that life throws at you here. And having cushion, if we're going to eat it all up, to be able to get you a little bit lower rate and a slightly lower payment.
Right.
But have something happen that you needed access to cash for, I'd rather have you have had your own versus borrowing additional on credit cards or other loans or any other way. So
Right.
Doesn't mean you can't always pay it off. There's no prepayment penalty on it. So once you get settled in and, maybe you're going to buy some furniture or something else, or rather than using a credit card, even if it's at 0%, Nebraska Furniture Mart card or something that requires a decent sized monthly payment to do so, where this might be a better option for you. So
I think it's a great option. And then you see those rates and it's like, wow. I mean, because, everybody, hears on the news and everything how we have elevated rates. Rates have come down.
oh yeah,
But then you take a program like NIFA and you look at some of these things like military home, 5.125. That's amazing.
That's amazing. Yeah.
Yeah, I mean, and the home buyer assistance, I just think that's a great thing. And then you can ask the seller. See, people don't understand that you can ask the seller to pay some of your closing costs.
Yeah, and depending on which type of loan you're doing and how much of a down payment you are or aren't doing will dictate how much you're allowed to receive in seller credits or lender credits or I guess interested party contributions, one way or the other.
Now, isn't it with FHA? Do they still? Is it 6% still allowed?
Yep, you can get 6% even with the minimum down payment of 3.5%. But
right
now, when you asked earlier, are you seeing more seller credits and that sort of thing? Which I am. They're more common.
I am too.
But I don't know if I've really seen, unless it's strategically planned out, anybody getting 6%.
Right. No, I don't see that either. You know what I mean?
I guess it also kind of depends. We say 6%. If it's a $100,000 purchase price, that's $6,000. That's not unheard of, right? If you're buying a $300 and some $1,000 house and getting 6%, that's an awful lot. But that can be. I tell it's kind of like I think it's what I say, the wild card in Uno for a lender, because we can use that seller credit for numerous different things to try to help structure the loan and pay down. Well, on NIFA, I can't buy down the interest rate. You can't pay points on NIFA, but pay for closing costs. FHA has a couple of different types of mortgage insurance. We can pay that with it. It's just I like it. It's a good way to be able to structure your loan.
Gotcha. And they can reach out to you and discuss NIFA if they have any questions about that, if they want more information on it. I think it's worth a call to just reach out to you and say, hey, take a look at this, because I just think there's an opportunity there. And so many folks are, affordability is a challenge, but I think there's an opportunity out there, especially with NIFA, where I think there's sometimes people think that they can't buy a home when they actually can.
Well, I think last time we did a full one of these on primarily just NIFA, something that time had come up, and maybe it's just not as relevant right now because houses are sitting longer and we seem like we're getting more seller credits and more inspections and things like that. So I expect when summer comes back around and the market picks back up, we're going to see some more competitiveness come, which multiple offer situations again. If rates do slide down further, it's going to attract more buyers that have been on the sideline, and I think we'll see appreciation, ramp back up here again, and we might get back in the same situation. So, there was a time frame where I haven't really had anybody have to deal with appraisal gap. Have you had to deal with an appraisal gap in the last couple of months at all?
No, nothing like that.
Right. Yeah. So there was a time frame where I've had clients that were first-time buyers or not, but they might have done the Welcome Home program, but they were a first-time home buyer and they had saved up money, like this client here, Chelsea, right? So Chelsea 904 says, as a future first-time home buyer, do you recommend saving up or just trying to buy with the minimum amounts? Kind of depends on how much you have saved at the moment, right? Or what kind of reserves you do have. Do you have a retirement account or anything else out there? But in this case, when the appraisal gap thing came up, right? Yeah. Somebody had saved up enough money to cover their down payment and the closing cost and the tax and insurance. They had their own funds. Yeah. But then when they go to bid on this house, and they didn't necessarily want to do the home buyer assistance. They wanted the lower rate, lowest payment. Right. They had saved up their money for this purpose, right? Right. Yeah. And then they had to compete against another offer, and the other offer had gone up above the asking price. Right. So they were like, I guess we can't do it because we don't have any more money. We only had enough to cover this. So then we figured out, well, we can use the home buyer assistance program
Oh, that's
to cover
awesome.
your down payment, not your down, well, I guess that part of, or some of your down payment and closing costs.
Right.
And then the money of yours that we didn't have to use, we can then use as a potential, if it ends up being needed, appraisal gap coverage.
Right. Oh, yeah.
So
That's awesome. That's amazing.
Where they were going to get kicked out because they didn't think they had enough, and we harnessed this. And then once we got the appraisal back, the house actually appraised to what they needed it to. So we still ended up getting to do their regular first home program. It was just the fear of we can't do it. And I wouldn't have been able to tell the selling agent or anybody else that, yep, we can cover an appraisal gap if we didn't know that we had that out there. So
right. And that is awesome. And I am so glad. I mean, people, in any market, it's always tough to buy a home in any market. There's always going to be some challenge out there. It's doable. But when rates were really, really low, you were in such competition where you'd make 5 or 6 offers or 7 offers or 10 offers before getting a home accepted, and you weren't getting your first choice.
Well, I also want to make sure that I want to come back to the Chelsea 904 here and try to maybe give you an option here. So as far as, I'm a big believer in the best time to buy is yesterday or the day before, the day before that, right?
Yeah.
I've seen clients that I've helped buy a house 5 years ago, first home, right? And have done basically nothing but maintain that house. They didn't add on square footage or update this. They just bought a home, and maybe they paid $180,000 for it 5 years ago, and they're either going to sell it or keep it or whatever they're going to do now. But the value has grown so much in that home that it's been such a remarkable investment for them, because no other investment do they have that grew that much in value.
Right.
Let alone the amortization they'd also paid down at the time, and had some other benefits. But the value had gone up so much that if you, where'd my calculator go? If you take a $250,000 house and say, I think Black Knight and Zillow and FHFA had kind of predicted around, what did it say, 4% even appreciation. That's $10,000 in a year. If I divide that out by 12, that says that $250,000 house is going up in value on average by $833 a month. So the sooner you can get in, the sooner you're the one gaining that, right? So if there is a means to be able to help you get into a home sooner versus later, especially in a time frame where we're kind of in a buyer's market, more so than it will be later, right? There's not as much competition out there. Sellers are still offering seller credits, doing repairs. You're getting inspections done, all of those items. I would rather have you keep what money you have saved up for, I shouldn't say I would suggest that you consider potential other things, right? That might happen. Cushion for unknown utility bills, or a air conditioner, or just
there's going to be maintenance,
doctor bill, anything else that comes up, right? Now, I also tell everybody, and a lot of these programs will actually suggest how many months of reserves should you have, right? As a requirement. Conventional, I think, is 0 to 1 or 0 to 2, depending on the situation, the debt to income ratio, and everything else. But if we're saying, hey, I don't really have anything saved up, but you're telling me I can buy a house with no money out of my pocket, I'll buy a house. Well, we probably don't want that to be the case either. That's not a real smart decision to make until you've been able to prove to yourself that you can save up enough money while maintaining, especially if we're going to increase your current monthly outflow, and then also expect you're going to be able to put money aside. But new jobs come in, this, it just depends. It's worth a conversation to kind of map it out.
Well, and this is, I'm going to bring up a chart here, and this is Douglas and Sarpy County, the median closed sales price going back the last 10 years. Okay. Look back in January 2015, $154,000 in Douglas and Sarpy County. And then this is monthly. And then if we do a rolling 12-month average, you can see where this is smoothing out that seasonality. But you can see where prices are flattening out here. And but boy, it's amazing to see some of that appreciation over the past few years. It's it's amazing to me. I'm kind of mad at myself. I should have bought a couple of more. You know what I mean?
Yeah, and I think what held me back initially when everybody was telling me to get into being a more of an investor, buy some rental properties and run them out, is I didn't want to have to. I felt like I didn't want to have the headache of property management,
Yeah.
repairs, things that happen, turnover, things like this. And at the time that I originally started looking at this, rates weren't in the 2s and 3s. This was a long time ago. But I remember thinking, am I going to do all of this to make $500 a month in cash flow? Right? Is it really worth it? I'm probably going to lose that at the end of the year, right? With repairs and updates. And even in the industry, I didn't calculate in my own brain. I couldn't tell myself, oh, but the house value is going up, right? Exponentially. So it's not like it's too late. You can always buy more.
Yeah, no, I mean, it's never too late. I mean, looking back, I should have bought more, but that's, hindsight's 2020 and everything. But it's amazing to look at prices, and today's high prices are tomorrow's good deals. We're going to look back 10 years from now and be like, Eric, we should have bought. Remember when they were 320? Remember you could buy a brand new home for 3.25? I bring these folks come in from out of town and they look at what we have in terms of our prices, and they are just blown away at some of the opportunity here.
I say the same thing, but you go look at houses. We had a gentleman on here, I think was out in Colorado, right?
Yeah.
See, so you look at the price of homes out in Colorado and what you kind of get in square footage or anything else for the matter for that price, and it blows people's minds away, right? But I will say the one thing, and that's another reason why you want a local lender here in a lot of ways, but I don't know if I would. I mean, it's Colorado, you get Colorado and so on and so forth, but they have these higher priced homes, but their real estate taxes are dirt cheap. Right? And so one of the, I sit here and go, all right, we're getting more bang for the buck in the house you're getting, but you're still paying for it monthly, right?
Yeah, that's true. If you
finance $1 million over 30 years at a relatively decent interest rate, it's going to give you a certain payment, principal and interest. Then you have to factor in the taxes and the insurance, and that's factored into your payment over a 12-month period, right?
Right.
Where out here, you could do a lot less in loan, get the same house, but the taxes, the insurance, the payment's going to be the same.
If you ever only had, a few weeks ago, we was on the stream, and we just for fun, we looked at prices. And if you really want to go into sticker shock, you want to have some fun, look at Aspen.
Oh man, why can't I think of the dang thing where the
I was like, oh Lord,
Aspen. What is that off of Dumb and Dumber? Where the swim upstream or whatever. I need to go back and watch that.
Of course, MH08 has his Airbnb in Aspen that he only stays out there for 2 weeks a year, he says. Yeah, he says, I remember what prices were 40 years ago. Exactly. And yeah.
I think the first
people were trying to sell me rentals when I was in for $30,000. Yeah, that's yeah. No, that's it is. And I took quite a hit in Aspen this year. So yeah, he's and Angie brings up a good point, and it's hard for almost everyone buying their first home. It's so hard, and that's why you see the median for the first time home buyer this year was 40 years old. That's an all-time high, and only 21% of buyers were first time home buyers, where it was 10 years ago that was 40%. So it's amazing to me how folks are locked out of the market, and that is because once they're in the market and they're gaining that equity, then they can roll that into the next property, right?
Yeah, or
you just got to get
for a lot of things. I've had a lot of clients that unfortunately they get so tied in. I mean, the rate's the rate, right? The loan is the tool. How many of your past clients or current clients that you've had, unlike my parents were in the same house for like 47 years, I think.
Right.
I don't think I have any client that I've talked to that's, I mean, I've got a few that have been in the house for 20 or 30 years or so, but how many of your clients do you think they've been in the same house that you helped and they've never bought again? Or never moved or never sold?
No, I mean, I've had folks where it's like, man, it's like a tree of people, where it's like, and then now I'm helping past clients' children buy homes.
Right.
So,
well,
but yeah, people tend to not, stay that long. I mean, life is going to happen. There's always going to be a real estate market because life is going to happen when somebody gets married, when somebody has a baby or passes away or gets divorced,
family, anything. Yeah.
It's going to create because there's always going to be a real estate market. And there's, just as a baseline, even when the market has been the sales have been depressed the last 3 years, there's still a baseline of sales that are occurring.
Yeah. I know several people here in town that had record years, right?
Right. Yeah.
Just depends on the situation. What I meant by that though is I have a lot of clients that I'd helped in the past that have ridiculously low interest rate. Right? Yeah. And we have more current homeowners have more equity in their house than we probably ever had before. Okay.
Right.
But that equity for a lot of people isn't doing them anything, right? It's not doing them any good other than kind of a safety net, but they also have called to check out, hey, what would it look like? We've had a baby. We need to do this, or they can't get off of that lower rate in their mind to go to a higher rate, but they really need the space or the house or this or anything else, right?
Right.
Or they don't even need to move, but they've had to rack up other bills, right?
Right.
And cash flow monthly, debt to income ratio is stretched beyond stretch. Because when I see stuff, I'm only seeing, not credit score. I'm seeing liabilities on the credit, right? We're not taking into account into our debt to income ratio calculations, at least for underwriting purposes, right? We're not taking, I do in my head when I'm trying to have a conversation with them about it, but cell phone and gas and groceries and kids and life and eating out in general, Netflix and Prime and everything else for the matter. But a lot of times when we find out that, hey, you've got this great rate on your house, you just got done telling me you don't plan on being in there forever. You're just waiting for the right time on the next one. But in the meantime, you don't want to do anything different with it. And you've racked up a bunch of credit cards and those rates have been super high. The car loan rates there for a while were ridiculously high. Medical bills were stretched really, really thin.
Right.
And if we know or they know that, hey, this isn't going to be my last house, well, maybe we should look at refinancing and getting you off that low rate and paying all this debt off and helping your cash flow immensely in the meantime, because by not doing anything, they've had a real hit to their credit score has gone down. So even if the rates dropped and got into a perfect situation, they have to sell that house to buy the next one, which is going to be a tricky situation when the market's hot if the rates come down.
Right.
And their credit might have been damaged enough by waiting off so long that now the terms on this loan aren't going to be great anyway. Right. So it's just we usually want to try to do some sort of annual review.
Yep.
And just put that crazy in the hat. I bet, though, you do have plenty of people that I've talked to that said, man, I should have bought 5 years ago. Right.
I know.
I think we're going to have the same thing happen, though. I honestly believe that home builders aren't able to build the homes fast enough. We had our population explode.
Right.
And as you just mentioned, the people buying have got pushed up a lot higher.
Yep.
I think millennials was the largest age group ever born.
Right.
So we have the most amount of first-time home buyers ever hitting their prime first-time home buyer age without enough homes. And if rates come down, I mean, it's one thing or the other. So I think it's a situation where in the future, we'll have some pretty good stuff in this dump in 35 years. Wait a second. Now, where's your moderator?
Just means you're not a quitter. And then he can put the drunk uncle in the garage. Oh, that's funny. Well, Eric, I tell you what, I really appreciate, and Clark says, Great show tonight, David and Eric. Well, thank you everybody for stopping in. Eric, thank you for
Yeah, sorry I got off topic. I was
no that and then if folks want to reach out to you, let me I'm getting a little better off of let's see here, my little let's see here. Oh,
hey, I do want to point out we didn't get down to the end of this stuff here, but I do one of the things that you had put on kind of your things we might cover here
yep.
was where I thought things were going to be at in 2026.
Okay.
I don't think you asked me specifically. I love how we almost backed me in the corner. What did it say here? It was real, not predictions. Well, what from rates realistically, not predictions. And everybody's only got predictions, right?
Right.
But, I do think, I just watch this here. As inflation comes down, as employment has been ticking up, these are economically two main factors that are going to determine if rates come up or come down, right? And
right.
If we see any kind of another round of quantitative easing at all to try to help, which I think there's been a lot of speculation about that. I don't think we're going to see some drastic up and down jumps on rates. It'll be volatile, but within a certain range, hopefully continuing to head down in the right direction. So I think we'll see good appreciation. I think the market's going to hit well. And again, not to push anybody off the ledge, but if you had a choice, call. It doesn't have to be me. Call somebody, get an application in, get a review done so you can plan things out for your year. Get up to somebody like David. He loves to drive around and show people houses.
Well, I'm going to add this too, because this is something that I keep track of, and I'm sure you watch it as well. Look at how the spread has improved.
Oh yeah, drastically.
Between the 10-year Treasury and the 30-year fixed rate mortgage. Look at 2024 January. The spread, the difference was 2.69, and then in 2025 it came down to 2.33, and now it's at 2.0. And so the spreads have gotten better.
Get down a little bit lower than that as well.
Yeah. So I mean, if it gets down to about one, isn't it historically about 1.5? Is that what it's 1.5 is a normal spread?
Yep.
Yeah. So the spreads are moving in the right direction, and this is this is from Mortgage News Daily. I keep track of that, and this year's the rates are going to go up and down, and but the spreads have gotten better.
Tomorrow is CPI, I think it is. Tomorrow we've got CPI data that comes out, and then Friday in the JOLTS report, and then I think Friday is the what is it? The here, I can tell you what it is here in a second. BLS. I want to always say BS jobs report, but the BLS jobs report will be coming out too. So
yeah, and it's I'm just gauging off of the reach outs that I've had so far this year and the number of, because sometimes first part of January, I'm like, wow, am I going to sell a home this year? Yeah. Sometimes I have that, in Christmas time, I'll be like, nobody's calling, but I mean, my phone is ringing. So I think buyers are out there, and I think there's opportunity out there.
For sure.
Is it tougher for folks? Yes, but there's going to be a market out there. And if, you got to be prepared. You got to line up your ducks and everything like that. And a
lot of people this time of year too, I think, are probably planning on getting taxes done, maybe getting some return back and having that added to their funds for help on a house.
Exactly. Yep. So if
thanks so much. I didn't mean to keep you past the thing.
No, I really appreciate you coming on the show. I always enjoy. I learn something every time talking to you, so I really appreciate that. I appreciate the way
I talk a lot.
But you do such a great job of taking care of my clients and doing such a great job on that. I really appreciate that. And our market has actually gone up. Exactly. So, I mean, Angie, I can't remember where you're from. I can't remember where Angie's from, but, and the market's going to vary. You talk to folks in Florida and in other places.
Ooh.
The market's going to be different in every place. So
every place. And most of the stuff that I get has to be averaged out nationally. I don't, don't try to be Southern California. Yeah, that's a tough, I look at some of the prices out there and I'm like, how on earth, you'd have to be 80 before you can afford a house out there. It seems so crazy. You know what I mean? Some, depends on where it's at and everything, but man, oh man,
no, I appreciate that. But Erik, thank you so much. I really appreciate it. And let's do some business, brother.
Yeah. Have a good evening.
Awesome. Thank you very much. You betcha.
Thanks,
Bye-bye.
all.
All right. Well, everybody, all right. I wish I was in Florida. I wish I liked Florida. Okay. And then at least we are not like Austin looking at a condo last traded at 1.1 million for 500,000. Wow. Yeah. It'll be interesting to I know an agent, a friend of mine in Austin. I'd like to bring her on as a guest and talk about that. So that's a good point. But everybody, hey, and if you need to contact me, I'll give you my, let's see, there's my phone number. Shoot me a text, give me a call, and then, and then be sure to hit the screen, give the stream a thumbs up if you don't mind. And we'll see you guys next week. I appreciate it. Thanks again. Bye-bye.